So when I approach the markets, I use something called a 3-step model or a triple X model, and that helps me execute every single trade. So I'm going to be breaking down a long I took over here, a long I took over here, and then the short which I missed out on, right? So when I trade, there's 3 simple steps I use. I need to know where to trade from, what to look for, and why you're looking for it, or why I'm looking for it, right? So if we just take a step back and understand what was going on. All right, so this is the S&P 500 or the ES futures chart on the 15-minute time frame. And so if we zoom all the way out, what we see here is basic market structure. So we have a high, a low, and then a high. So Thursday and then post FOMC going into Friday, what we can see here is we are very much in the premium, right? The reason I say that is because this is the 50% area and anything above that is a premium. So these were the key levels that I had over here. Now, in this video, I'm going to be breaking down how I use the footprint charts to take these longs, right? So I had a couple of my key levels resting over here, and I'm going to be breaking this down step by step. So this was the first long that I took, right? So the first long that I took came just after 10 a.m. Eastern, right? So we're going to be breaking this down step by step. Now, the first thing to understand is I only trade and execute at my key levels. And so this was a key level down here. This was the first key level. And now my second key level was up here, right? This is where price resisted. So everyone's heard of the term support and resistance, but few understand how to use that to their advantage, right? So essentially what was going on here was we had a support here, right? And we had a resistance over here. So these are key levels of either demand or supply or support and resistance, right? It's the same idea. Now, if we quickly jump up to the 15-minute time frame, I just want to break down how I got those levels because this is the most asked question I get. Now, when I find my levels, I typically will choose a 15-minute fair value gap from the past that has given us some reaction, right? So this is something traders need to get practice at, right? Your levels are going to develop with time, right? Your levels are not going to be perfect straight away. Your levels are going to develop with time. So this was a level that I had from the 7th of January. And so what happened is we had a passive seller sitting over here, right? This is what confirmed the level. We had a fair value gap and we had absorption or passive sellers stepping in and they drove price down, right? So that is the first level that I was looking at. So if we continue to extend this over to the right, we see rejections, even FOMC, right? FOMC gave us a very clean rejection at this level. So one thing I often do is I look at news events to see how the levels are reacting, right? So this was during or just after FOMC. Again, we had passive sellers sitting at this level. Now, if we continue to go to more recent price action, right? More recent price action over here, this is what we see, right? So FOMC or post FOMC held over here. Then Thursday PM session, again, sellers are in control. So going into Friday, we don't want to ignore this level. And so this is how I do my pre-market plans, right? So one of the core problems that I see traders having is that they have lots of knowledge, but they're not able to translate it into a profitable plan. And the reason for that is because you have lots of concepts, but they're cluttered in your brain. So in order to reduce that clutter, you want to think of trading in 3 simple steps, right? You need to know the following steps. You need to know where to trade from, right? You then need to know what to look for inside of this zone, and you need to understand why the market wants to go down or why the market wants to go up. It's 3 simple steps that I call the triple X system, right? So going down now to the 1 minute, I'm going to be breaking this trade down in terms of the footprint charts, what I was looking for on the footprint charts, right? So let's break this down. So the first thing is assuming you have your key levels correct, then the order flow is going to work out. So if we just kind of go all the way back to the market open, so this is now 9:29, 9:30. Now I have a rule, I never trade the first 5 minutes, right? So I let the first 5 minutes show its hand, right? The first 5, maybe even the first 15 minutes over here. So here we have the first 5 minutes. So for those who trade the opening range breakout, the orb, 5 minute or 15 minute, this is typically what you want to be looking for. So if this is the first 5 minutes over here, 9:30 to 9:35, right? Let's label that in yellow. Here's the first 5 minutes. Now, when we have the first 5 minutes, what you want to look at, or what I was looking at, is the rejection we had off here, right? This is the first kind of rejection we had off this key level. And how we look at the rejection is through footprint charts, right? So candle by candle, we want to break down how the footprint charts were reacting, right? What data were these footprint charts giving us? So here's where we break it down. So we had 929, and then we had this big green candle, right? The market opened bullish. Now the rejection, or the first rejection, was over here, right? So we had 929, 930. So I'm only interested in the candles after 930. So here's where we have our first rejection off this zone, right? So this was key level 69.63. If you're trading ES, you needed to have 69.63 to about 69.55 area. Now, if we take a look at this rejection, right? This rejection was essentially what I was looking for in terms of longs, right? This is why I looked for longs. So what we can see here again, a quick breakdown of footprint charts, right? So footprint charts, once you come into your level, you're looking at aggressive sellers and aggressive buyers. And so on the left, we have the aggressive sellers. On the right, we have the aggressive buyers. Now, when you see this red inside of the candle, that means that there's more aggressive sell orders than aggressive buy orders, right? That's where the red actually comes from. So what we're seeing here is a lot of sell orders not being rewarded. Now, I got a question about that, so we're going to break this down. What does it mean by the sell orders not being rewarded, right? This is a common question I get. Now, if we take a look at, if we just take a look at this rejection, right? So this was at 932. So the rejection at 932, we wanted to see this, right? So this candle over here is the same as this candle over here. Now, again, if I just move this footprint charts over here for people so they can see. So here's the 932 rejection. Lots of aggressive sellers, right? But the market breaks higher. So what's really going on here? This is a confirmed level of demand or support, right? Let's call it support. So this is a confirmed support area. Right, support. Now, why is that? Let me spell that right. Support. Why is this a confirmed support area? Because we see aggressive sellers not being rewarded. Now, what I mean by that is, if you have a lot of sellers over here, right, we see these sell orders resting over here. Lots of sell orders, their only goal is to drive price lower, right? So we want to see price going below the zone like this, right? We want to see breaks to the downside. But as we can see here, 932, 3, 4, 5. The first 5 minutes, we have a rejection higher above the level. So this here is really a support level. The reason it's a support is because we see the following steps. We see aggressive sell orders, right? And we see no reward, right? So this is what we're looking for. We see aggressive sell orders, but we don't see any reward. Now, from a footprint chart perspective, again, when we look at this, what we're typically looking for is the delta or the color inside the candle, right? So another core problem is that traders use technicals, but they don't understand what drives technicals. And so that leads to more problems than certainty. You can take any strategy you want, right? EMAs, crossovers, ICT, SMC, Elliott waves, basic support and resistance, which is what this video is about. Take basic support and resistance areas and just put order flow with whatever it is you're doing, and you'll have a much accurate read on price, right? So why do we see a support area? Because aggressive sell orders are present and aggressive sell orders don't get rewarded. They fail, right? Because price breaks higher. So that's the basic premise of what I was looking for in the first 5 minutes. Now we have a key level over here, right? So now with this key level over here, right, what I'm waiting for is, now I have a rule. I'm not allowed to trade in between my levels. So in my pre-market plan, right, this is another problem I see. Traders go into the session without having a pre-market plan. And that's the best way to fail, because you would rather have your levels, sit tight and execute only at those levels, as opposed to turning up the charts and choosing random continuations, random reversals, and not understand what you're looking for. So the process of trading is about defining your levels, right? Key level 1, key level 2, waiting for your levels to be hit and simply trading breakouts from those levels, right? So every single strategy that I've seen can be boiled down into having a key level, waiting for an entry, and understanding the entry, right? Those are the only 3 steps that you need. So I'm never looking to trade in between my key levels. So if we continue to play price on, here we have the first rejection, right? Here we have the first rejection. Now, this first rejection over here was where I started to get interested, right? So this was the first long that I took on, here we go. So here's the first long that I took over here, right? So we had, this is now the 15-minute range, right? This is the 15-minute range. Here was my execution for that day, right? So my first execution, as you can see, came at 69.72, stops below 69.62. So we had a 10-point risk for about a, well, I had my TP up here, for about a 15-point reward, so about a 1.5 risk reward, right? So as we can see, we reversed from this area, didn't really capitalize on this trade as much as I wanted to. But I want to break down the execution, right? Because the execution is what I get asked the most about. So if I just show you over here, this was the 15-minute opening range breakout, essentially, or the 15-minute breakout. So if we have a 15-minute low, sorry, a 15-minute high up here, so I'll put that in red. If we have a 15-minute high and we have a 15-minute low, what we're seeing, or what was going through my mind, there's a few things that are going through my mind, right? So first, over here, we've already established we had these aggressive sellers over here failing. So what's really happening here is that there are passive buyers. That's what's going on, right? Passive buyers. Now, for those who don't understand passive buyers, I'm just going to quickly break that down because I do get questions on this as well. So from a footprint chart again, now the numbers you see on a footprint chart, these are only aggressive participants or market orders, right? So if we just break down a couple of things over here, if we see 67 for 18, that means that there's 67 sell orders, right? Aggressive sell orders. And there's only 18 buy orders, right? Market buy orders or aggressive buy orders, right? Now, again, there's 45 for 0. That means the same thing. There's 45 market participants going in to sell at market prices, aggressively looking to sell. And there's no market participants looking to buy. So this is at 69.61, roughly 69.62 area. So that represents this region. So when we see a lot of aggressive or market participants resting in this region, right, but the market breaks higher, these sell orders are being absorbed or they're being trapped. By who? Right? They're being trapped by these passive buyers. So the next logical step is when we come into this zone, when we reject off this zone over here, right? Either we reject higher or we continue to crash lower and then re-break the zone, right? So again, the most important thing is having a zone and understanding what to look for inside the zone, right? So this was my kind of execution criteria. So again, what got me interested was this wick, right? So a lot of traders will use a wick, but they won't have any confirmation as to whether to go long and short with that wick. So typically a wick is not enough. Using a 15-minute opening range breakout is not enough, right? You need to see whether there's passive buyers in this region. Now, how we do that is by understanding what was going on in this level and just outside the level. So just this entire region over here, right? This is where I was looking to execute, and I did execute a long position, right? So my execution again for that day or that Friday was 69.72, right? That was my execution, 69.72. So if we go to 69.72, a little bit late actually, I should have executed down here, but 69.72.5 stops just above this wick, and I was basically looking to target the top of this zone over here, right? Roughly a 1 to 1.5 risk reward, right? So what gave me the confidence to go long in this region, right? So if I continue to play price on, there we go. There was my long setup. Now, this long was valid not because of the wick, but because of the order flow inside of the key level. So here was our first rejection, right? Here was now our second rejection, somewhere here. There we go. So this is what I find interesting about trading, right? So when we have this long kind of wick rejection over here, we want to understand this price action, because when you see a long trade like this, right, this here is, again, it's passive buyers that are stepping in, right? Passive buyers here, and then passive buyers here, right here. Now, quickly breaking this down, again, footprint charts, we have a left number, we have a right number. Now, it's very clear from this candle what was going on. So again, we have a huge amount of aggressive selling, and I want traders to appreciate what's going on here. Aggressive selling just means that there's red delta inside the candle. So all this over here is negative delta, right? It's red delta. So for example, if we see 165 for 236, the right number, so the aggressive buyers, are outnumbering the left number, which is the aggressive sellers. Now, if we look inside the zone, which is most important, inside the zone, the same way we looked over here, we're now looking over here, we see again huge amounts of aggressive sell orders, more so than we saw over here, right? This is a huge amount of sell orders, right? Even without reading the numbers, we can see sell orders resting over here, aggressive sell orders here, and aggressive sell orders here. Now, In terms of my execution, the way I like to look at it, once I know that sell orders are present, and once I know that they're struggling to break below the zone, again, this zone is intact, we keep breaking higher, my execution typically will look something like this. So I'm waiting for price to enter my key level, right? That's step 2. Step 1 is we need to have a key level. Step 2 is we're looking for that rejection with, once again, the order flow. We need to see what's going on here. Now, in terms of going long, I'm comfortable to go long at any point here. So this is where I went long, right? I went long because I want to see price breaking above a candle body, right? That's typically what I'm waiting for. So you can use candle breaks, but only if they're backed up with the order flow. So here's where I went long. Again, stops below here. My long position, I think, was 69.72.5. So a little bit later than I wanted to enter, right? So again, the confirmation to go long, right? This confirmation to go long comes from the footprint charts, okay? Now, in terms of capitalizing on this trade, as we can see, I was up probably around well, at this point I trailed my stop, so probably 1.5 risk to reward. Didn't capitalize on this trade. Now, the reason why is because I was holding up to this key level and I wanted price to break above this key level. It never happened. So that's an example of not being, I guess, greedy and taking your profits where you should do and getting out the trade, right? So here's an example where the trade reversed on me and I closed pretty much somewhere around here, right? That's where I closed. So good trade, but bad risk management, right? Well, bad trade management, I guess. So now we follow the same process again because I took longs again, right? I took longs again over here. So my second execution was 69.65. 69.65 stops below 69.57 and then targeting the top of this zone over here, or the bottom or the top of this zone over here, right? So again, here was my final TP. So risking about $300 to make 1,000, 3.3 R risk reward, right? After the initial loss that I took. So again, breaking this trade down, just from a candlestick perspective, what was going on here? Again, we see 15-minute range, we see rejection 1, we see rejection 2. Now, one thing I've noticed from my own experience is often you want to wait for 2 rejections inside of a zone, right? So again, we follow the same steps. We enter a key level, right? So here's our first tap, right? Our first tap came over here. Now, usually, if the first tap doesn't hold successfully, you want to start looking for the second tap, only with the confirmation of order flow. So here's now the second tap. So again, we're looking for the same criteria. So step 1, define your key level. Step 2, understand what makes a key level valid. Understand what you're looking for over here. So again, the rejection, if we break that down over here. So here we go. Now, coming into the zone again, this is now going to be 10:29, 10:30 area. So when we come into this zone over here, again, we're interested inside the zone. We see a very similar pattern. We see heavy aggressive selling as we enter the zone, right? Heavy selling aggression as we enter the zone. Now, same thing over here. We see this heavy selling aggression, and what's really going on here is a couple of things. We see a lot of the sellers over here not being rewarded. Now, this not being rewarded concept is shown as we break above the level. So it's kind of like logic. It's very logical, this, right? So again, if we break above the level, despite having the aggressive sellers over here, what does that tell you, right? Why did these longs play out? So again, my execution was going to come around here. So execution for that day, if I quickly break it down, came at 69.65, right? There was my execution. 69.65 here. 69.65. Stops below the local low down here. And again, we are looking to target the previous session high. So we're looking to target this high over here. So this is probably decent risk to reward trade, just probably around a 3R risk to reward or just under a 3R risk to reward. There we go. So my exit for that day again wasn't perfect. My exit for that day was around here. So roughly a 2.5R risk to reward. Now, once again, I'm just gonna break down the theory behind what was going on because it's the same theme. We had passive buyers here, we had passive buyers here, and then we had passive buyers over here. So we're seeing the rejection of aggressive sellers, right? That's what's going on. Now, for the final trade, just the long trade over here, breaking it down one more time, Without even reading all the individual numbers, what we can see is heavy selling aggression coming into our key level. So this key level on ES, 69.63 to about 57.55 area. So you want to understand the main interactions between buyers and sellers in this zone. Now, when you look at the aggressive selling inside the zone, you want to ask yourself a simple question, right? Simple question. And this is a question I start to ask myself here, right? Before I even take longs. I want to ask myself, okay, who is being rewarded, right? So if there's aggressive selling over here, again, we can see that via the footprint charts. If there's aggressive selling, right, which direction is the market breaking above the zone? Are we breaking higher? Are we breaking lower? And the secret with order flow is to trade as the market's breaking higher with the order flow confirmation, right? As opposed to waiting for sweeps, breaks, I fair value gaps, and SMT divergences. You don't need to focus on that. You just want to focus on entering based off the rejection of buyers or sellers, right? So define your key levels, wait for price to come in your key levels, and then look to go long or short, right? And that was the thesis of this trade. So once again, there we have it, right? So again, my target, my exit for that day was around here. And again, what made me exit here? That's another question I get, right? Why did I exit here? So there's a couple of reasons for that. First of all, we needed to really understand what was going on here, what was going on here. So again, I had key level 1, key level 2. The way that I trade intraday is I'm typically looking to trade between levels, right? I'm in trades for around 10, 15, maybe 20 minutes, maybe 30 minutes, depending on, you know, the volume of the market and stuff. But I'm not looking to hold trades. I'm not looking to swing trade or anything like that. I'm looking to define my levels and understand where the market is reacting at those levels.